Welcome to vTalkInsight, Risk Sentiment Daily for March 16, 2026. The Middle East energy shock has now evolved into a full stagflation scare, and cross-asset risk sentiment has turned decisively defensive. Across assets, the backdrop today is clearly risk-off. Equities have already shed around 5% since the conflict began, while volatility indices and treasury market swings sit near recent highs, signaling that investors are actively de-risking and paying up for protection. The central force behind this shift is the Middle East energy shock. The effective closure of the Strait of Hormuz and related disruptions have pushed Brent crude back above $100, with scenario work now openly discussing levels closer to 150 or even 200 if the blockage persists, forcing markets to rethink both inflation and growth trajectories. That macro repricing is showing up in positioning. Institutional hedging demand is near all-time highs, investor cash buffers are low, and flows have rotated away from growth and technology into energy, industrials, materials, and more defensive equity sectors, while the US dollar has emerged as the primary safe haven as both treasuries and gold struggle with higher yields and inflation risk. The first and dominant driver is the prolonged Middle East energy shock. The closure of the Strait of Hormuz has created the largest oil supply disruption on record, with about 6.7 million barrels per day offline and virtually no viable alternative routes for Gulf exports. Brent crude has surged back above $100 and has traded near $120, while oil is up roughly 10% this week and around 40% over the month. Shipping activity through the strait has largely halted, leaving thousands of vessels, including over 100 container ships and tankers, stuck or rerouted, and war risk insurance premiums have jumped to roughly $3,000 per container. Policy responses so far offer only marginal relief. Strategic reserve releases by the US and IEA members cannot match the scale of loss flows. Logistical bottlenecks limit how fast barrels reach Asia, and temporary U.S. waivers on Russian oil merely allow some cargoes already at sea to clear, while also boosting Russian revenues by an estimated $150 million per day. Because there is no clear alternative route or diplomatic off-ramp, markets have shifted from worrying about the intensity of the conflict to its duration. Forecasts now contemplate losing up to 20% of global oil supply if the closure lasts 3 months, with price scenarios in the $147 to $164 range, and even talk of $150 to $200 in worst cases, a profile that keeps risk premia elevated and equities vulnerable to further downside. The second bearish driver is stagflation and higher for longer rates. Oil above $100 is already lifting gasoline prices toward $4 per gallon in the U.S., while mandates to curb power and fuel use have emerged in parts of Southeast Asia and Europe, and consumer surveys show gas price expectations at their highest since 2022. At the same time, activity data are softening. U.S. fourth quarter GDP was revised down sharply to 0.7%. Second quarter growth forecasts have been cut to below 1%, and demand destruction is spreading as households trim discretionary spending. Packaged food companies struggle to pass on higher input and logistics costs, and business and consumer confidence wobble. Inflation, however, remains sticky. Core PCE inflation is running at 3.1% year-over-year, above the Federal Reserve's 2% target, and importantly does not yet reflect the latest oil spike, while markets have pushed out Fed rate cuts through 2026 and even started to price the risk of a hike by late 2027, and the European Central Bank is now expected to deliver more than one additional increase. That combination of weaker growth and persistent inflation points squarely to stagflation risk. Bond markets are increasingly pricing sustained high oil feeding into inflation, with U.S. yields moving higher and traditional 60/40 portfolios underperforming, yet equities remain near all-time highs in some regions and are seen as complacent about the prospect of a prolonged oil spike and delayed monetary easing. The third key risk-off driver is private credit and liquidity stress. Private credit has grown to an estimated $2 to $3 trillion, and signs of strain are mounting as funds face significant outflows, clients request redemptions, and some large vehicles impose withdrawal gates, particularly where roughly 30% of portfolios sit in software names exposed to disruption. These pressures are spilling into other markets. A sharp sell-off at the front end of the U.S. Treasury curve was linked to broad liquidation and a scramble for liquidity as retail funds and private credit vehicles met redemptions, while investor cash levels across mutual funds and households are already low, reducing the scope for buy-the-dip support if equities fall further. For now, stress still looks localized rather than systemic. Industry specialists argue that most of the pain is concentrated in retail-oriented products. Banks are less leveraged and better capitalized than before 2008, and investment-grade primary markets remain open. But the risk remains that a major private credit fund halting redemptions could trigger a sharper liquidity squeeze and force more aggressive deleveraging across risk assets. Against these headwinds, one important stabilizer is resilient investment-grade credit markets. Primary issuance has been strong, led by large, high-quality technology companies raising funds for capital expenditures, and there is little evidence that private credit concerns are materially constraining access for top-tier borrowers. The quality mix in the investment-grade universe has actually improved. The share of AA-rated bonds is at a 7-year high, while the lowest rung, BBB- exposure, sits at a record low, suggesting that, at least in public credit, leverage and downgrade risk are not at the extreme seen in previous cycles. There is also more flexibility in where companies fund. Tech issuers have roughly doubled their borrowing in non-dollar markets this year, easing pressure on U.S. dollar bond demand and signaling that global investors still have appetite for high-quality paper, even as spreads in the tech segment have widened back to levels last seen in 2004 as supply and demand move toward a new equilibrium. A second constructive theme is the renewed focus on energy security and transition tailwinds. The current disruptions have pushed European natural gas prices up about 70% year-to-date and exposed vulnerabilities in fuel supply, prompting policymakers and corporates to revisit long-term investment plans in both traditional infrastructure and renewables. Physical energy infrastructure is increasingly seen as strategic. Power plants, pipelines, and grid assets, alongside renewable projects, are drawing fresh interest as anchors of energy security, while recent shocks have reignited U.S. and European debates around efficiency measures and alternative energy, in echoes of the 1970s push into new technologies. Flows are reflecting this shift. Exchange-traded fund data show rising allocations toward energy, industrials, and materials, with small-cap energy names beginning to outperform from historically cheap levels, even as investors acknowledge that energy equities have become overbought in the short term and that supply chain regionalization will take years rather than months. The final, more tentative, support is lingering hopes for Federal Reserve easing over time. Despite markets largely pricing out cuts through 2026, the Fed is expected to stay on hold rather than launch a new hiking cycle, and some analysts still see scope for 1 or 2 rate cuts this year if weaker growth and labor data persist. Central bank governance, while noisy, appears relatively stable. Courts have quashed subpoenas targeting the Fed chair, legal challenges are viewed as politically motivated and lacking evidence, and markets broadly see the institution's independence as intact, which helps anchor expectations that, once inflation pressure from energy recedes, the Fed could eventually pivot without being forced by politics. In contrast, other central banks face even less room to maneuver. With oil-driven inflation pushing some investors to price additional hikes in Europe and the UK, the U.S. policy stance can still look relatively flexible, leaving a narrow but important path where softer data allow modest easing that would support risk assets after the current stagflation scare peaks. To sum up, today's risk sentiment is firmly risk-off, shaped by a historic Middle East energy shock, rising stagflation fears, and growing concern around private credit and liquidity, even as high-grade credit markets, the push for energy security, and the prospect of eventual Fed easing offer some counterweights. Watching how long the Strait of Hormuz remains disrupted, how quickly inflation data reflect the oil spike, and whether credit stress stays contained will be critical for gauging the next phase of repricing across equities, bonds, and currencies. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.